Hello everyone, we are Group 6. We'll present you the financial decision analysis for Maruti Suzuki India Limited and Tata Motors. This is the agenda for today's discussion. Financial decisions. In 2003, Tata Motors acquired Daewoo Commercial Vehicle Company. This investment decision required Tata Motors to raise funds for the acquisition. The financing decision raised their debt to asset ratio sharply, as seen in Figure 1. Tata Motors acquired JLR in 2008. This financing decision pushed the debt to equity ratio up. This is shown in Figure 2. Both MSIL and Tata Motors have the strategy to decrease leverage and save themselves from potential takeovers. If we observe debt to equity ratio, Maruti has progressively been able to decrease its debt to equity ratio from 24% to 2%, which reflects the decreasing proportion of debt with respect to its equity. Tata also has been able to decrease the debt to equity ratio with respect to its equity. Tata also has been able to decrease the debt to equity ratio from 93% to 79%. Now coming to the observation of cash flows. The CFO for Maruti Suzuki India has always been positive and more than CFI. The CFF indicates that Maruti has not depended much on outside sources for financing. In 2010, company made huge investments which resulted in significant increase in cash inflows due to operations. Maruti has negative CFI consistently, indicating it is investing in asset creation and working towards ensuring future earnings. This is a healthy trend for the company. Also, CFO has been consistently more than CFF and CFI, again indicating positive trends for the company. Coming to Tata Motors, CFO was negative till 2004. After 2004, CFO has been consistently positive. It has also been more than CFF and CFI, indicating a positive trend for the company. In 2009, cash inflows due to operations increased significantly. CFI has been very close to zero until 2008. From 2008, the company has started deploying its extra cash in investing activities that should lead to future benefits to the company. CFF has always been in positive territory for the last 10 years. Tata Motors is depending too much on outside finances. In 2008, CFF increased drastically due to increase in debt for JLR acquisition. Now we'll observe a few ratios. First of all, price to earning ratio. For Maruti, in 2004, it was reported that price to earning ratio was 26.49. That means investors were willing to pay rupees 26.49 for every rupee earned by Maruti on their behalf. By March 2005, price to earning ratio was decreased to rupees 14.24. The main cause for such disparity could be decreased profitability. From 2006 to 2008, price to earning ratio value continued to decrease due to financial slowdown. For Tata Motors, price to for Tata Motors, it could be established that during 2001-2002, Tata Motors incurred substantial losses. However, a negative price to earning ratio does not necessarily indicate that the company was going bankrupt. It could be because the company has invested significantly in new products that it hopes to sell in future. During 2001-2002, Tata Motors launched Indica V2 and Tata Safari. Following the same trends that of Maruti, from 2006 to 2008, price to earning ratio value had decreased, possibly due to financial slowdown during the period. Boosted by strong share price and profitability, price to earning ratio from 2009 to 2011 has increased significantly. Until 2010, there was no significant difference between price to earning ratio of the two companies. However, in 2011, Tata Motors has registered price to earning ratio which is 274% more than that of Maruti. which clearly shows that fundamentals of the company has gone up. Price to book ratio. In March 2004, Maruti had a price to book ratio of 4. This means that Maruti shares were 4 times more costlier than its asset could be sold for. In other words, investors thought Maruti worth 4 times its current value and was poised to grow in the future. In 2005, the price to book ratio has fallen down to 2.78. From 2006 to 2008 to 2009, the price to book ratio has gone down every year. Positive price to book ratios from 2006 to 2009 indicates that Maruti has been earning positive returns on its assets. From 2002 to 2004, the price to book ratio has gone up every year for Tata Motors, indicating good performance of the company. During this period, the investors believed that investing in Tata Motors share will give positive returns. Starting 2006 to 2009, the price to book ratio has gone down every year. This was the case for Maruti also. This could be due to slowing economy during that period. The comparison of price to book ratios of the two companies from March 2009 to March 2010, Tata Motors was perceived a better investment option than Maruti. Return on capital employed (ROCE). In 2003, ROCE increased tremendously due to significant increase in profits margin and total asset turnover. ROCE tanked in 2009 due to drastic decrease in profits margin. For Tata Motors, the increase in ROCE till 2005 was due to significant increase in profits margin and total assets turnover. ROCE tanked in 2010 due to drastic decrease in profits margin and total assets turnover. By the end of 2005, due to large increase in total assets turnover and equity multiplier of Tata Motors in comparison to the increase in these parameters of MUL, ROCE of Tata Motors was quite larger than that of MUL. In 2009, ROCE for Tata Motors fell below than ROCE for Maruti due to fall in total assets turnover. Return on equity (ROE). We could see that both the companies saw a similar trend for a period of 10 years. Tata Motors saw a 51% decline in profit due to the global slowdown during the famous recession hit year. This was also the year when Tata acquired Jaguar. Both the companies did well in 2009-2010. Soon the profits started to fall due to the decreased sales. Economic slowdown and slow recovery process were the main reasons for the decreased sales. Coming to the last ratio, earnings per share. From 2003 to 2007, there was continuous increase in profits, so the EPS value increased during this period. In 2002, the value of EPS was negative for Tata Motors as the expenses were more than the revenue the company brought in. From 2002 till 2007, the company delivered better EPS year on year. Both the companies registered a drop in EPS during the years 2007 and 8. The financial crisis of 2007 and 8 was responsible for this year. So this was our financial analysis for the two companies. Thank you.